After months of volatile market conditions, we believe it is paramount for investors to build resilience into their portfolios following the pandemic. Many investors hold traditional global bonds, thinking that they are enough to help weather market volatility. However, as we saw during the first quarter market sell-off, even global investment-grade and high-yield bonds can experience double-digit declines. The good news is, investors can now look to the Chinese bond market to provide higher yields and resilience against continued market uncertainty. As the world's second-largest bond market, China offers plenty of opportunities for investors to build their exposure across government debt and corporate credit, allowing for portfolio diversification. As major global indices continue with their China bond inclusion process, index tracking funds have bought into the market, boosting demand for high-quality Chinese bonds. China's bond market is rapidly expanding with a 3-year compounded annual growth rate, reaching 15% and 8% for onshore RMB and offshore USD markets respectively. Even in the first quarter of 2020, Chinese bonds saw foreign inflows as investors sought safe haven assets with income and diversification benefits. Going forward, we see more foreign institutions increasing their exposure to the asset class. So, what do we find appealing in Chinese bonds? Chinese bonds still enjoy higher yields than other regions as global central banks cut rates. Onshore and offshore Chinese bonds are less volatile, but have enjoyed higher returns and income compared to global bonds over the past 5 years. Chinese bonds are less sensitive to global risk factors. Onshore Chinese bonds remained resilient through recent global market volatility. In addition, onshore and offshore Chinese bonds have a low correlation to each other. This enables fund managers to generate alpha through dynamic asset allocation between the two markets. Chinese bonds have resilient fundamentals with low expected default rates. Deleveraging in early 2018 eliminated the least worthy credits, and early action from China's policymakers kept the onshore bond markets functioning, even in the global liquidity sell-off this year. Furthermore, Chinese credit has much lower exposure to sectors vulnerable to a global slowdown. Blackrock China Bond Fund offers superior returns with 8 consecutive years of positive returns. Quality dividends offering an annualized yield of over 6%. Throughout the significant market volatility in the first quarter of 2020, the Blackrock China Bond Fund managed to hold up well, driven by nimble allocation between China's onshore and offshore bond markets. Our overweight position on onshore RMB bonds helps to hedge against the risk of liquidity crunch in international markets. Blackrock China Bond Fund leverages a go-anywhere Chinese bond strategy, with access to all China markets, including onshore, offshore, and the offshore hard currency market. The fund has flexible exposure to over 250 highly diversified quality holdings, allowing investors to enjoy potential stable yields, capital growth, and diversification benefits, while capturing opportunities in all market conditions.